So, I wanted to break down one of the most powerful yet underused IRS strategies for business owners, the Augusta Rule. It's a legal provision that in the tax code lets you pay yourself significant money and not pay income tax on it. No, this is not some shady loophole. I tell my clients about this all the time. It's right in the Internal Revenue Code under Section 288G.
It was originally created for homeowners near master golf tournaments in Augusta, Georgia, hence the name Augusta Loophole. And it allowed them to rent their homes out for 14 days in a tax year. So basically, if you rent your personal residence for up to 14 fewer days in a year, that rental income was non taxable. So, why does this matter to business owners? If you own an incorporated business like an S Corp, C Corp, partnership, or multi member LLC taxed as a partnership, your business can rent out your home for legitimate business activities and you keep the rental payments tax free. So, how this actually works. Number one, you have to have a qualifying business entity. Sole proprietorship, single member LLCs generally can't use this strategy on themselves, but corporations and partnerships can. Number two, hold a legitimate business event at your house. So think strategy meetings, retreats, client dinners, training sessions, board meetings, those would qualify. Number three, you have to rent your home for 14 days or fewer during the year. The 14-day limit is very, very strict. If you were to go over this, it could actually disqualify the exemption. Number four, charge your business a reasonable market rental rate. This is critical. You must base the rent on local comparables like hotel meeting rooms or like an Airbnb. You must document everything: written rental agreements, invoices, agendas, attendees lists, minutes, meetings. If the IRS were to ever audit you, documentation is essential. So let's break this down. Say your business rents your home for 8 days a year. You determine the fair market value is $1,500 per day. Total rental income is $12,000. Because it's under 14 days, you don't report $12,000 as taxable income. The business gets to deduct $12,000 as a legitimate expense. Example number two, annual retreat, 10 days total of rental time. You rent a reasonable market rate of $1,000, total $10,000. Your business deducts $10,000. You pay zero income tax on that $10,000. If you'd earned that in a salary or a distribution, you might have owed anywhere from 30 to 37% in income tax. That's a huge saving. So here are the rules that you must follow. 14 days maximum. Stay within the annual limit. Fair market value. Documented and justified. Clear business purpose. Meetings, content creation days, retreats, proper documentation. Agreements, agendas, sign-in sheets, photos, invoices. No personal use counts against this, and not a home office deduction replacement. So look, this looks great on paper, but don't rush into it without planning. There are real audit risks if you mess up. Common mistakes are charging unreasonable rental rates, no real business purpose, poor record keeping, and going over the 14 days quietly losing your tax-free status. Here's an example of a real consequence. One business owner rented out their home for 16 days at $750 a day and claimed the Augusta exclusion. But because they exceeded this limit, the IRS made the entire amount taxable and imposed penalties. Look, the Augusta rule is a real and powerful tool and strategy when done correctly. If you move money from your business to your pocket as a tax-free rental while your business still gets the deduction, look, The Augusta rule is real and powerful when done correctly. You can move money from your business to your pocket as tax free rental income while your business still gets the deduction. But the difference between smart tax planning and a disaster is documentation and compliance. Always talk to a professional or a tax advisor before implementing. Thank you for watching my video. Please subscribe, hit like, and share it with someone who you think could use this strategy.